if you're investing in Melbourne and Sydney, the numbers don't seem to stack up commercially. What are your thoughts there, Steve, in investing in Sydney or Melbourne?
Yep, so Sergio, you are spot on. The yields in Melbourne and Sydney are typically pretty terrible. Melbourne, they're really bad at the moment. And by bad, I just mean low. So like you are talking like 3 to 4% typically on a lot of good quality assets. Sydney a little bit higher, like you can get kind of 4 to 5% on average if you go out of the exact kind of CBD area. Recently, we've bought in like the Northern Beaches and Penrith and areas like that and got like a 5 to 5.5% net yield. So there are some options there, but the yields aren't, and the numbers don't make sense. With interest rates where they are, you're not going to be cash flow positive. Doesn't mean it's not a good asset. It could still grow. So same fundamentals as residential. The property could still double in value in 10 years. And you can make a good return that way. But if you are looking to build a passive income in the next 5-10 years, you do have to look at some high yielding locations. So Brisbane and Perth, some really good options at the moment. You can get 5.5 to 7% net yields in most asset classes. And then regional, you can get even more, as long as you take into account, obviously, the vacancy risk with it there.
Yeah, I mean, Sydney and Melbourne haven't really been investable for people that are probably listening to this podcast and, your clients for a while. Like, you're looking at 4-3% returns. If you're buying all cash, could be a different story. But Melbourne particularly has had some of the lowest cap rates, particularly for retail in Melbourne City. It just doesn't make sense. The numbers just don't make sense if you're leveraging this property. And a lot of the time, the assets that are getting bought in these locations are by owner occupiers as well, and they push down the yields, which pushes up the prices.
Yeah, so there's nothing wrong with buying there, but you're buying for different reasons. You're not buying for cash flow. You're buying with the hope of capital growth, which is the crystal ball stuff. But it doesn't mean it's not a bad market. There's still really short days on market there. It's not like the yields are terrible and the properties are sitting there for years at a time. There's still some good, strong fundamentals, but for guys like us, Andrew, who are trying to build a passive income to retire early, yeah, buying a high yielding location makes more sense. And in terms of risk, the vacancy rates in Melbourne are not that much lower than anywhere else. So most areas in Melbourne were kind of 0.2, 0.3%. Somewhere like a Brisbane where you get a 6% net yield, most areas are 0.3, 0.4%. So they're somewhat comparable. It's not like it's that much better of a location.
Yeah, it's just the perceived lower risk of buying in a capital city. I think we've already done a couple of podcasts on this actual topic, so we don't need to go too deep into it. But yeah, if it doesn't make sense, it doesn't make dollars.